When I say stock trading, you probably picture the New York Stock Exchange trading floor. Traders yelling tickers and prices across the room, buying and selling stocks in person. That used to be how most trading was done. These days, you can do it all online, and technology has allowed everyday people to take up trading at home to try and make money. But here's the thing. Despite the fact that trading involves stocks and other investments, it's seen as a very different practice from investing. Being a trader, whether professionally or as a hobby, is different from being an investor. And while you've probably heard of people making quite a bit of money off trading, it's an area most people are best served avoiding. Why? Let's talk about it. The literal definitions don't help. If you look at the literal definitions of investing and trading, you probably won't grasp the difference. Investing is the act of spending money with the hope of generating some benefit or return in the future. Trading is the act of buying or selling investments. Not very clear, right? There's no technical distinction dictating what counts as trading and what counts as investing. But the terms are used to refer to two very different approaches to making money. An investor is someone who places their money in something and looks to profit from that asset growing over time. A trader is someone who makes money in the short term by buying and selling stocks frequently. In other words, while one relies on gradual appreciation, the other focuses on market volatility. Two main differences. There are two main areas where trading differs from investing: the timing of trades and the analysis of stocks. For timing, investing is typically a long-term strategy, whereas trading is more short-term. When you invest in a stock, you're betting that over time, the company will grow. You're aiming to sell the stock 5, 10, even 30 years from now. On a day-to-day basis, the price of a stock may fluctuate. Some investors try to take advantage of that by buying when the price is abnormally low. But once the purchase is made, the focus tends to shift to long-term movement rather than short-term volatility. Trading, on the other hand, is the fast and furious approach. It involves buying and selling investments to take advantage of short-term price swings. Day trading, for example, involves buying and selling stocks the same day. Swing trading expands the process to a few weeks or months. Sometimes traders make buys and sells within a matter of seconds. Because of this, traders submit many more trades than investors and often cycle through many more positions. The analysis difference. To understand how analysis varies between traders and investors, we need to explain the difference between a stock's price and its intrinsic value. The price of a stock reflects the number of buyers and sellers trading that stock at that point in time. But past the stock price, there's some intrinsic value, a true worth of that stock. Over time, the price should track closely to this intrinsic value. But human factors like fear or greed might lead a stock's price to deviate from its actual worth from time to time. Investors take two approaches. Passive investors ignore short-term fluctuations and look only to benefit from rising intrinsic value. Active investors try to estimate a stock's intrinsic value so they can buy the stock for less than its worth. Both approaches generally depend on the intrinsic value of a stock increasing. Traders, on the other hand, only care about the stock's price. There is no attempt to estimate intrinsic value. Many traders buy and sell stocks without even knowing what the company does. They're only looking to take advantage of short-term swings or trends in the stock price. For this reason, traders focus their analysis on technical indicators. These are measures that only take into account historical pricing information to help determine whether there's a developing trend or pattern they can quickly exploit. The reality check trading can seem very alluring. Competition, fast trades, quick payoffs, and with all the ads you see online of millionaires explaining how they went from zero to hero with their $300 trading strategy, it probably seems easy. But trading is a high-risk practice. Most traders put a lot of money behind individual trades, sometimes even borrowing to leverage their returns. This exposes them heavily to short-term volatility. It also requires a lot of effort and time. And when you consider that you're competing with industry professionals with massive amounts of money, cutting-edge research, and algorithms that can trade faster than you can blink, it's just not a fair fight. Now, I'm not saying you can't make money trading. Some people do make a full-time living from it. But trading is a lot like playing poker. You can be very good at it, but there's a lot of chance involved. And with other great players at your table,